Hi, this is Daniela Cambone for StansberryInvestor.com, and welcome back to our summer series. Today is a really special episode commemorating a very important event in history. President Richard Nixon ended the gold standard and ushered in the fiat money era on August 15th, 1971. So it's the 50th anniversary that we have officially been off the gold standard. I want to talk about where we are at today. Were we better off before? I could not think of a better expert for this conversation than Jim Rickards, author of Currency Wars and numerous other bestsellers. Jim, always good to have you on our show. Welcome back.
Thanks, Danielle. It's great to be with you, especially on this special anniversary. You know, the 50th anniversary of anything is the golden anniversary. So I think
how ironic, right?
At the risk of putting a pun out there, we're going to talk about gold. But yes, the golden anniversary of Nixon going off the gold standard.
So I want to ask you because, when we got off the gold standard, it was to many economists' delight who thought or still think that gold is a barbarous relic and that we are much better off on the fiat money system. And in fact, our economy would have never thrived had we gone off the gold standard. Were we better off before or today, Jim?
Well, we were much better off. Actually, we were better off before the Fed. The United States, people hate central banks. We had two that we got rid of before the Federal Reserve was created in 1913. But the first bank in the United States we got rid of in 1812. The second bank we got rid of in 1836 under President Andrew Jackson. From 1836 to 1913, there was no Fed. And it was the greatest period of prosperity, low inflation, invention, efficiency, almost in recorded history. So we get along fine without the Fed, and we're much better off with the gold standard, no doubt about it. When you said economists criticize gold, I would just remind the audience of two things. Number one, economists are wrong about almost everything. So if you actually look at their track record in that sense, they seldom get things right. Certainly the Fed never gets the forecast right. And I wrote a book which I know you're familiar with, The New Case for Gold. But that book is not just another book on gold. I specifically refuted, there's 7 or 8 persistent criticisms of gold that you hear over and over again. They're all wrong. And I just took them one by one and said, here's why it's wrong, here's why it's wrong. And so that's kind of the baseline in terms of understanding why we're better off with the gold standard.
So the economy thrived better under a gold standard than
Sure.
the fiat monetary system. And now, would you argue that the greatest point in favor of the gold standard is that the Fed wouldn't be able to expand or retract the monetary supply as much or as little as they want?
Well, not as much as they want. That's a very good point. People say, well, the standard criticism, and it's wrong, but the standard criticism is, the great thing about the Fed is they can do that. They can expand the money supply and contract the money supply as needed to keep inflation under control or to grow with the economy. Well, you can have that with a gold standard. In fact, we did from 1913 to 1971 in various ways. We had a gold standard, but we also had discretionary monetary policy. The Fed was expanding and contracting the money supply from 1913 to 1971, and we had a gold standard. So they're not incompatible at all. But it does mean that you can't go too far. So it kind of puts a lid on things. Until 1945. The law in the United States was the base money supply, M0, that's what the Fed controls, could be 2.5 times the U.S. gold hoard, the gold in our possession at the market. So taking originally $20.67 an ounce, later $35 an ounce, take the amount of gold times $35 an ounce, and whatever that number was, multiplied by 2.5, and that's how big the money supply could be. But so you can't go beyond that. But I actually talked to Ben Bernanke about this because you hear over and over, the gold caused the Great Depression. Gold was the problem in the Great Depression. And I researched it. And actually the leading scholar after Milton Friedman was Ben Bernanke. And he showed with, very precise detail that the money supply during the Great Depression never exceeded 100% of the gold. In other words, the money supply could have been 2.5 times greater than it was in the Great Depression with a gold standard. So gold was never a constraint. The Fed screwed it up. The Fed messed it up badly, but it had nothing to do with gold because they were nowhere near the ceiling. And when I talked to Bernanke, I said, Mr. Chairman, I said, this is my understanding of your research. Do I have it right? Do I have a correct understanding? He said, yes, you do. So gold was never a problem in the Great Depression. So you can have both. You can have a gold standard and discretionary monetary policy. You just can't get crazy.
So I know we've spoken in past interviews about the likelihood of us returning to a gold standard. I know you said it's probably very unlikely, even though there have been some politicians who have been vocal and pushing forward for this. What would a new Bretton Woods system look like for you? Is it tied to, or is it involving digital currencies then, Jim? What do you think?
Well, there's a lot of confusion about digital currencies, and people think of Bitcoin and all that. But the central banks are moving towards central bank digital currencies, which are not cryptocurrencies. The message traffic can be encrypted, but digital dollar is still a dollar, a digital euro is still a euro, and a digital yen is still a yen, and so forth. The central banks would still, have discretionary authority over monetary policy. It's just that you probably wouldn't have any paper money. And payments in a digital dollar, for example, could be faster and cheaper than what we have today. We all use credit cards. That's an electronic payment, but there's a merchant acquirer fee of 2.5% on, when you charge something, the merchant gets 2.5% less than what you pay because they have to pay that amount to a processor to get their money. Well, you could probably eliminate that. So it would make payment systems cheaper. We might have wallets at the Fed. We might, Jim and Daniela and the audience might have an account at the Fed. You could disintermediate the banking system, but that's not inconsistent with gold. In fact, I've written recently about how, we're going to be walking around with 400-ounce bars in our pockets and purses. No, obviously, probably won't even have a bag or a purse of 8-gram coins, which was true prior to World War I. But why couldn't you have a digital gold-backed currency? In fact, some versions of that already exist. So all you're doing, you put the gold in a safe place outside the banking system. You have an account, you send them the money, they buy the gold, there it is, and then you use your debit card in gold.
Just entertain us for a second here, Jim. Let's pretend we were on a gold standard today.
Right.
What greatest problem would it eliminate?
Well, it depends how you do it. And this is the problem with gold standard. Gold standards have failed in the past, as we know, and governments always make the same mistake, and it's a mistake you have to avoid, which is they get the price wrong. When you go on a gold standard, you're fixing a parity between, say, dollars and weight of gold. You're measuring weight of gold in dollars. So it's no different than any other cross rate. If you have the euro US dollar cross rate or the dollar yen cross rate, well, this is just going to be a dollar gold cross rate with the gold measured by weight. But you got to get the price right. So could you do it at $1,800 an ounce, which is about the current price? Well, legally you could, but that would be a fiasco because it's highly deflationary. In other words, people say you can't have a gold standard because there's not enough gold to support commerce and leverage and industrial and commercial loans and the whole financial system. There's not enough gold. That's nonsense. There's always enough gold. It's just a question of price. Now, could you do it at $1,800 an ounce? No. But could you do it at $15,000 an ounce? Yes. So if you said, okay, Jim, you're in charge of going back to the new gold standard. Let's be a convening power and get the G7 and the G20 finance ministers together and have a new Bretton Woods type conference. Maybe I'm here in New Hampshire. Maybe we could do it up at Bretton Woods, which is just a little bit up the road than that Washington hotel. But the point is, there are a lot of technical issues, but the biggest single issue they would face is getting the price right. And I've calculated it several different ways. And the low end is $15,000 an ounce. That's one of the reasons I make that my forecast, because we might have an orderly process, the kind I just described, where you convene the session, get G20 finance ministers, and you do it right. I don't think that's going to happen. I think what's going to happen is the system's going to fall apart. There's going to be a panic style loss of confidence in not just dollars, but euros and yen and all central bank command currencies. And they're going to have to do it on an emergency basis. So you're going to get there either way. But the number one question is, what's the price?
And I can guarantee if there were to be an emergency meeting, you'd be the first person they'd call.
Well, hopefully, I've already done the math, so I can tell. I can give an answer in 5 minutes.
Okay. Final thought, Jim. I know you're enjoying family time. I don't want to take you away from them. Just last point. I said it's the 50th anniversary, an important event here. I guess a major lesson we should learn from this, or from being on the gold standard, that we could perhaps apply to today's economy.
Well, everyone remembers August 15th, 1971. Richard Nixon ended the gold standard, kind of, but not exactly. What he did, he said foreign trading partners can no longer redeem dollars for gold. He said, but they were the only people who could. Gold was contraband since 1933. American citizens couldn't own it. And so he said, you can no longer, and he said it was temporary. If you go back and watch that Sunday night speech, August 15th, 1971 was a Sunday. They interrupted Bonanza, which is the most popular TV show in America at the time. But Nixon said it's temporary. And I spoke to Paul Volcker about it, and I spoke to Kenneth Dam, who was dean at the University of Chicago Law School. He was there. He was Volcker and Dam were both in Camp David, which is where they cooked this up with Nixon. So I got firsthand accounts, and they said we thought it was temporary. We're going to have a new Bretton Woods, go back to gold, and it just never happened.
Wow.
So the lesson is, but that happened in stages. It started in World War I. They said, give us all your gold, we'll give you paper money, but don't worry, you can redeem it. Then they melted it all down into 400-ounce bars and said, well, we're going to leave it in the vaults of the banks. Then the central banks took it from the commercial banks, so there was no more gold for anybody. Then the treasuries and the finance ministries took it from the central banks. The Federal Reserve has a gold IOU on their balance sheet. It's first item on the asset side because the Treasury owns the gold. Everyone thinks the Fed owns the gold. Treasury owns the gold. And then Roosevelt made a contraband. Americans couldn't have it. And then only foreign trading partners could get it. Nixon ended that in 1971. So my point is, August 15th, 1971, a very big deal. But the lesson is that happened in stages over about 40 years. So that's how the elites operate, just a slice, a slice, a slice, a slice. People are asleep, they're complacent, and then it's all gone before they know it.
Piecemeal.
Yeah, exactly.
Piecemeal.
It's exactly
Fascinating insights, Jim. Makes me think of the regulation that's coming on board for crypto, that it might not be one sweeping change, right? But you'll see it.
It's there's a name for it. You're right. It's called piecemeal social engineering. It's proposed by Karl Popper, and the biggest advocate today is George Soros. Enough
said. Jim Rickards, go enjoy your family. Thank you so much for joining me for this special edition here on StansberryInvestor.com. Thank you. Okay. And thank you for watching. We'll have much more for you, so be sure to stay tuned. In the meantime, don't forget, DanielaCambone.com. That's the place if you want premier access to videos you won't see anywhere else and special offers. Sign up today. That's it for me. Thank you for watching. I'm Daniela Cambone.